If you run a business or plan to start one, understanding your numbers isn't just useful, it's essential. And when we say your numbers, we're not just talking about profits or sales. We're talking about the deeper numbers that show how your business is truly performing. That's where financial ratios come in. Now, before you think this is going to be some complicated math lesson, relax. You don't need to be an accountant to understand what these ratios mean or how to use them. In fact, once you learn them, they'll become one of the sharpest tools in your business toolbox. Let's start with the most basic one, the current ratio. This tells you whether your business can pay its bills in the short term. It's a simple comparison of your current assets to your current liabilities. If your ratio is above 1, that means you have more assets than liabilities and you're in a relatively safe spot. But if it dips below 1, it means you might not have enough money to cover upcoming expenses. Think of it like checking if your wallet has enough to pay your dinner bill. No matter how good your food was, you need to settle the check. That's exactly what this ratio shows, your short-term financial health. Next, let's talk about the gross profit margin. This one reveals how efficiently you're running your business. It compares your revenue to the cost of producing your goods or services. The higher the margin, the more money you keep after covering those direct costs. If your margin is shrinking, it could mean your costs are rising, your prices are too low, or both. When you track this regularly, it gives you early warning signs before your profits disappear without a trace. Moving on, there's the net profit margin. This ratio tells you how much profit you actually make from every dollar of sales after covering all your expenses. Unlike gross profit margin, this one includes everything: rent, salaries, electricity, even your coffee machine. A healthy net profit margin shows that your business is not only running, but running well. It tells you how much of your sales revenue is left as actual profit. If you're putting in the work and growing your sales, but your net profit margin is still tiny, something's eating up your earnings behind the scenes. This ratio helps you find it. Another powerful number is the return on assets. This tells you how effectively your business is using what it owns to generate profit. In simple terms, if your business owns equipment, tools, or even just cash in the bank, this ratio shows how much profit those assets are helping you create. It's like asking, is my money and equipment working for me, or just sitting around? A high return on assets means your resources are being used wisely. A low return might mean it's time to rethink how your assets are managed. And finally, we've got the inventory turnover ratio. This one applies if your business deals with products, whether you sell food, clothes, gadgets, or tools. It shows how often your inventory sells and gets replaced over a period. If your turnover is high, that means your products are moving quickly, which is usually a good sign. But if your inventory turnover is low, you might be stocking too much, or maybe your products aren't appealing enough to buyers. Either way, this ratio points out whether your shelves are generating cash or collecting dust. Now, you might be wondering, how often should I check these ratios? The answer is simple: regularly. You don't need to obsess over them daily, but reviewing them every month or quarter gives you control. When these ratios are part of your regular routine, you'll be able to make better decisions, faster. Let's be real. Running a business means making decisions all the time. Should I invest in more staff? Should I launch a new product? Can I afford to expand to another location? These are big questions, and the answers become clearer when you understand your financial ratios. They help remove the guesswork and show you what's really happening behind the scenes. Here's the best part. These ratios are universal. Whether you run a cafe, a construction business, an e-commerce store, or a manufacturing unit, these numbers matter. You don't need a degree in finance to use them. All you need is your financial data, a calculator, and the willingness to take a closer look. And don't be afraid to adjust as you go. Maybe one month your net profit margin takes a dip. Instead of panicking, you'll know where to look. Is it expenses? Is it pricing? The ratios guide you to the root cause. That's what makes them so powerful. They don't just report problems, they help you solve them.